market crash often leads to mass layoffs and economic instability, putting millions of jobs at risk. At this moment, are you prepared for job market chaos? Warren Buffett has warned that when the next market crash hits, unemployment could soar, leaving you and your family in a financial bind. If you're relying on a paycheck to secure your future, a market collapse might make your income disappear. With that being said, stay tuned as you will have a clearer understanding of how to prepare for this upcoming market crash and why it matters for the generations to come. Let's get started. Warren Buffett's investment strategies. Warren Buffett's investment strategies are grounded in value investing and long-term thinking. At the core of value investing is the idea of purchasing stocks that are undervalued relative to their intrinsic worth. Buffett emphasizes the importance of thorough research and understanding a company's fundamentals before making an investment. This approach encourages investors to look beyond short-term market fluctuations and focus on the long-term potential of their investments. As we face the possibility of an impending market crash, these strategies become even more crucial. By adopting a long-term perspective, investors can avoid the panic that often accompanies market downturns. Instead of reacting impulsively, Buffett advocates for patience and discipline, reminding us that market corrections can present unique buying opportunities. One of Buffett's most notable investments was in Coca-Cola during the late 1980s. At the time, the stock was undervalued, and Buffett recognized its strong brand and growth potential. His decision to invest not only yielded significant returns but also demonstrated his commitment to holding quality companies for the long haul. Another example is his investment in American Express, which he made during a crisis in the 1960s. By believing in the company's fundamentals and staying the course, Buffett reaped substantial rewards as the company recovered. By applying Buffett's timeless strategies, investors can navigate the challenges of a market crash with confidence, focusing on long-term value rather than short-term volatility. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Historical market crashes. Throughout history, the stock market has experienced several significant crashes, each leaving a lasting impact on investors and the economy. Notable examples include the Great Depression in 1929, the dot-com bubble burst in 2000, and the financial crisis of 2008. Each of these events triggers widespread panic, leading to massive sell-offs and economic downturns. Warren Buffett has navigated these turbulent times with remarkable resilience. During the Great Depression, he learned the importance of patience and the value of investing in strong companies. In the early 2000s, when the dot-com bubble burst, Buffett famously avoided technology stocks, focusing instead on businesses with solid fundamentals. His decision to invest in companies like Coca-Cola and Procter & Gamble during this crisis showcased his belief in long-term value over short-term speculation. The financial crisis of 2008 presented another challenge, but Buffett seized the opportunity to invest in distressed companies like Goldman Sachs and Bank of America, demonstrating his knack of identifying value in times of fear. Each of these historical events taught Buffett and investors alike valuable lessons about market cycles, the importance of research, and the need for a disciplined approach. As we look at current market conditions, characterized by volatility and uncertainty, understanding how Buffett responded to past crashes can provide crucial insights. By applying these lessons, investors can better prepare themselves for potential downturns and make informed decisions that align with Buffett's time-tested strategies. Signs of an impending crash. As investors, recognizing the signs of an impending market crash is crucial for safeguarding our financial futures. Several key economic indicators can signal trouble ahead. For instance, rising inflation rates often erode purchasing power and can lead to increased interest rates, which may slow down economic growth. Additionally, high unemployment rates can diminish consumer spending, further straining the economy. Consumer confidence is another vital indicator. When consumers feel uncertain about their financial situation, they tend to cut back on spending, which can negatively impact businesses and the stock market. Market sentiment and speculation also play significant roles in precipitating crashes. When investors become overly optimistic, they may engage in speculative trading, driving prices to unsustainable levels. This bubble can burst when reality sets in, leading to a rapid decline in stock prices. Financial experts are closely monitoring current market conditions, and many express concerns about the potential for a downturn. Analysts point to the combination of high inflation, fluctuating interest rates, and geopolitical tensions as red flags. By staying informed about these indicators and understanding the underlying market dynamics, investors can better prepare for potential challenges and make more informed decisions in the face of uncertainty. Recognizing these signs early can be the key to navigating a turbulent market landscape. Impact on future generations. The potential upcoming market crash poses significant risks for younger generations, impacting their financial stability and career prospects. One of the most immediate concerns is the likelihood of job losses. Economic downturns often lead to layoffs and hiring freezes, which can disproportionately affect younger workers who are just entering the job market. This could result in a generation facing higher unemployment rates and limited job opportunities, making it challenging to build a stable financial future. Moreover, an economic downturn can lead to reduced wages and fewer benefits, further straining the financial well-being of young adults. However, amidst these challenges, there may also be investment opportunities for those who are prepared. Historically, market crashes have presented chances to buy undervalued assets, allowing savvy investors to build wealth over time. This underscores the importance of financial literacy for future generations. Understanding the fundamentals of investing, budgeting, and saving can empower young people to make informed decisions during economic uncertainty. By equipping themselves with knowledge, they can navigate the complexities of the financial landscape and seize opportunities that arise during downturns. Encouraging proactive measures is essential for preparing for economic challenges. This includes developing a solid financial plan, diversifying investments, and continuously educating oneself about market trends. By fostering a culture of financial awareness and resilience, young generations can better withstand the impacts of a market crash and emerge stronger in the long run. Buffett's advice for investors. Warren Buffett has long been a beacon of wisdom for investors, especially during turbulent times. One of his most famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." This philosophy encourages investors to remain calm and rational when the market is volatile. Instead of succumbing to panic, Buffett advocates for a focus on fundamentals and long-term value. He believes that understanding a company's intrinsic worth is crucial, regardless of short-term market fluctuations. Buffett often emphasizes the importance of patience, stating, "The stock market is designed to transfer money from the active to the patient." This highlights the need for investors to adopt a long-term perspective, allowing them to ride out market downturns and capitalize on recovery. To implement Buffett's advice, viewers can take several actionable steps. First, conduct thorough research on potential investments, focusing on companies with strong fundamentals, solid management, and competitive advantages. Second, consider dollar-cost averaging, which involves investing a fixed amount regularly regardless of market conditions. These strategies can help mitigate the impact of volatility and reduce the average cost of investments over time. Also, maintain a diversified portfolio to spread risk across various sectors and asset classes. By following these principles and staying true to Buffett's philosophies, investors can navigate turbulent times with confidence and position themselves for long-term success. If you want to know more about the path to prosperity, check out the video here and see you there.